Hi, I'm Kenny Klaus, and this is State 48 Homeowner.
So today we're talking about, we've built up a lot of wealth, especially with the market appreciating and where we bought the house at and now what it's worth. And so often that's kind of monopoly money that's just sitting out there. So I'm here with
a gift.
So I'm here with Steve Farrington with Loan Depot. Let's talk about what we can do when we bought a house. Either we've paid it down or the market's appreciated or both, and now it's worth a lot more than what we paid for it. Let's talk about what we can do with that equity.
Sure. Well, let's first talk about equity, because I discuss this quite a bit, especially with first-time home buyers or maybe those that owned a home, but they weren't the primary buyer at the time. They were just a co-signer or a spouse. So equity is the value of your property versus the principal amount owed against the home on your first mortgage, second mortgage, or any combination of liens on title. So that difference is going to be the equity in your home. A lot of times people don't realize that the down payment they actually put into the home when they first purchased it is that instant equity. That's your first position of equity. So if you put 3% down or 20% down, like we've talked about in other conversations, that's instant equity in your property.
And also, if it appraises for more than what you paid for when you're buying it, there's some instant equity.
There's some instant equity as well. Exactly. If you agreed on a $300,000 purchase price and your appraisal came back at $305,000, well, there was
$5,000 of
a gift.
Yep.
But the other pieces of equity and how we gain equity in our home, first and foremost, is through our payment. Every month when you make your mortgage payment, part of it goes towards the principal balance of your loan.
Which I think most people, when they're just starting off on a home loan, it's not happening too much there because we're stacking the interest a lot higher on those first payments.
True, but think of it this way. If a typical $300,000 loan, and I'll just use that figure. I know that they're probably a little bit higher in today's market, but a $300,000 loan, when you're making that principal and interest payment at a 3.25% interest rate, sure, of that $1,300 a month, maybe $800 of it initially is going towards interest. But guess what? You're putting another $500 in your household piggy bank, so to say, in equity. So that's $6,000 a year.
Yeah, and then you get 5 years down the road, 10 years down the road, that division changes quite a bit, and
it grows over time.
More
You're right.
principal along the way. That's why it's always beneficial to stay in your house for more than 6 months to a year.
Absolutely. So we have your down payment. You have your potential appraisal over your purchase price for instant equity. You have the principal portion of your monthly payment that helps you pay down your principal balance of what's owed against your property. But the biggest piece that we've experienced in this market recently has been appreciation. Mm-hmm. Appreciation of home values has been in the double digits. I don't want to give a figure because I'll be wrong tomorrow when the new reports come out. But it's been fantastic. We're seeing tremendous growth in our marketplace here in Arizona and watching homes appreciate at a fantastic rate, which is a wonderful thing because equity can be used for so many things in other facets of our life. Again, historically, I'll just kind of go historical as far as appreciation rates. I mean, typically appreciation hovers in the Phoenix marketplace right around 6% a year, which is fantastic.
Yes.
It's a really good appreciation rate. We've experienced higher than that recently. So how do I use the equity is, I guess, sometimes what people ask me, what people ask you, what people ask us is, how can I utilize the equity in my home?
Or we transition it from monopoly money into real money.
And that's a good point. It really can be like a windfall for some of us. And we talk about the wealth of home ownership all the time in our meetings and gatherings here. But your home's equity can be used for a lot of different things. And the top 5 that we ran through were removing your PMI, your private mortgage insurance.
Yeah.
You can consolidate debts outside of your home loan. You could get cash out to do home improvements, upgrades to your property, rather than getting secondary financing. And one thing that we've seen some people do recently is take money out for down payment on another home, whether that's their next step up property, their downsized property, or an investment property, owning that second home for rental.
Which in both cases, you have the opportunity to take care of both, because you can get a down payment for another home and be able to keep the one that you have now as a rental and go live in the other one. Or I love my house. So then you can take some of that equity for a down payment on a different house that you intend to use as a rental.
Absolutely. And that's something that it's a great source to allow us to continue to build on that wealth in purchasing another property, because now maybe you have, so let's say you take money out for the down payment on your next home. You're going to buy an investment property. Now you have two homes that are appreciating assets that you're adding to your household portfolio.
And one of them is also providing cash flow. And as you get older, as you approach retirement, that cash flow is going to be much higher because, the rents go up, but your mortgage payment stays the same.
Yeah, it's amazing how that happens on a 30-year fix, right? But a couple of the other things that we talk about using your home's equity through a refinance is a lot of times when people first get into a home, they'll put less than 20% down. So they're going to have that private mortgage insurance. And I think we've talked about it.
Yeah.
Private mortgage insurance, whether it's a conventional body or an FHA loan, it averages, let's just say $150 a month, just so we have a figure to work with. If you could refinance and eliminate that private mortgage insurance and save $150 a month, it may be well worth it just to get rid of the
and you
PMI.
may not even need to refinance to do that.
Nope.
If you've got a conventional loan, you just call us. We'll help you prepare some comps and send those off. We do it all the stinking time because it's one of the biggest gifts that we can give to our clients is, hey, because what, 150 times 12, that's
what, $3,000?
Yeah.
It's $3,000. That's a lot of money.
Yeah.
And that's net. That's after your taxes that you're paying that. And you and I have talked about for no reason, especially if you have that tremendous equity in your home, you're paying it for no reason. So you can take $150 and hang it out the car window and let it go on the 101.
And it does the exact
same thing. But it's a fantastic tool to use. And as you mentioned, if you have a conventional loan, you don't necessarily have to go through the expense of refinancing to get rid of it. You can contact your loan servicer to find out how you can do that, and then contact us to maybe get those comparables, order an appraisal if you have to, or maybe refinancing is your best option because you can lower your interest rate and eliminate the PMI.
And in super aggressive markets, it's often, if you've been in the house for a little while, they probably aren't even going to, do that appraisal all the time.
Not all the time. You're correct. The one caveat to that when we're talking about private mortgage insurance is those that have used the FHA loan to purchase. It's a little different. You do have to refinance into a conventional loan to eliminate the FHA PMI. It doesn't drop off after a certain equity period or time period. It's a misconception that I hear quite often in my field, but it's definitely something that you could refinance to get rid of it, get into a conventional loan and eliminate that PMI. And a lot of times...
And with that loan to value ratio, you're a little bit more competitive too.
Absolutely. Absolutely. That's definitely something to consider. So first and foremost, we'll go back to the down payment, but getting rid of the PMI if you have it. It can definitely, and again, it doesn't cost anything to call, talk to us about the PMI, what it would cost you to do it and what that payment difference looks like. The other one is consolidating debts. A lot of us, besides our home, we've got other debts, whether it's an auto, a truck, a student loan, credit card debt. Maybe we had a medical bill during, this time, or we had an emergency that came up, or a combination thereof that we can use our home's equity to kind of reset and pay off those debts and just combine it all into our mortgage payment.
Yep.
A lot of times you'll find that the interest rate on a credit card or an auto loan or a truck loan, depending on your credit, can be a bit higher than today's fixed rate loans.
Yeah,
so
especially
it may be,
like you said, fixed rate versus variable rate. It may be great at one point, but things change quick.
Well, and a lot of times we get trapped into the introductory rate. that somebody will offer us for credit financing. And it'll be interest free, or it'll be a 0% for 6 or 12 months. But when that period ends,
Bam.
And it can be devastating. And then you're making minimum payments, feeling like you're just on a treadmill, never getting ahead. One of the things that people will say when they do consider that in debt consolidation on a refinance, well, I don't want to reset to a 30-year fixed. I've already been in my home for 3 years. Well, most lenders, including Loan Depot, will actually allow you to reset to a customized term. So if you don't want to go into a new 30-year, you can do a 27-year or a 25-year or a 22-year fixed, whatever period you've been in your home, and amortize your payments over that period because you don't want to reset to a new 30-year term. One thing I talk to people about quite often is, let's say you consolidate a few credit cards and a small medical bill that you had, and that was costing you about $400 a month in minimum payments. If we've refinanced, got your new mortgage payment, and you were making that same mortgage payment plus that $400 a month before comfortably with your income, household income or personal income, if you took that same $400 a month on a new 30-year fixed mortgage and applied it towards the principal of your new 30-year loan, you would pay that loan off probably about 10 or 11 years sooner.
And that will save you a heck of a lot of money.
Save you a heck of a lot of money. So again, it's talking to me, talking to us to kind of get that guidance so you know. I think we've talked about it before. First, get the who to learn the how. So one of the other things that we talked about, and a lot of people are doing it now in this current market, is with lower inventories, maybe they're taking cash out to make their older home or their current home new again.
Yeah, because sometimes we're like, oh, we want to move, we want to have something new, but we love our neighbors, we love the school, we love our neighborhood, and the general layout of the home, but it's just so dated, so we can fix all that.
How many people have you guys heard, again, as real estate agents, have you heard says, well, if I could just take that new house, Scott, and put it in my current neighborhood, that would be perfect. How possible is that, Scott?
And it is. it is, because we can just redo our home. I mean, you think about it, flippers are doing it all the time, just completely gutting a house and making it brand new. Most people don't need to go to that extreme, though, to just update their kitchen and baths and
don't have to tear it down to the studs to get that HGTV look. Is that what we're talking about here? Okay. Yeah, and it
shiplap everywhere.
But the home improvement can definitely be something that you can use your home equity for, to make it new again, refresh the kitchen, update your bathrooms, get rid of the tub that you don't use anymore because your kids don't take a bath anymore. They're not 2 years old anymore, and you just want a nice stand-up walk-in shower.
Put a pool in.
Pool is a fantastic addition because some people, that's what they want here in Arizona, and their current house doesn't have a pool. So it's definitely something that you can use that equity that we've been talking about, rather than financing it through a pool company. They're probably not going to want me to say that.
But again, let's go back to the conversation we had before, those introductory terms and understanding what all of that looks like versus the stability of that fixed rate mortgage.
Absolutely. And one of the other things that it's an improvement, because it's not one of the sexy improvements that I've had people take cash out of their home to do, is replace that 20-something-year-old air conditioning unit and system. Mm-hmm. It's a pretty expensive repair, for lack of a better term. But being
a new underlayment on the roof, those kinds of things.
The roof, the AC, the water heater, getting a tankless water heater, all of those things that can improve our quality of life that maybe aren't as visual as the brand new kitchen or the HGTV bathroom. So again, no offense to HGTV, I watch it all the time, but it's definitely something that you can utilize your home's equity for, is to update, upgrade, and renew the home that you love so much.
Yep.
The other thing that we wanted to talk about as far as your home's equity, we talked about down payment for another home.
Or a rental property.
Or a rental property, which is really an investment. I mean, we're talking about, in addition to our existing portfolio, we have our current home. We're going to take a little bit of cash out to buy a rental property, a small condo, wherever, whatever. But some of the other things that you can do with your home's equity, because again, it's your cash, you've built up that equity, is invest in other opportunities, whether that be a rental property, maybe a business. Maybe you could take that money and invest in other vehicles that interest you.
Yep.
Those are the things that we can use, that gift we've been talking about, the home's equity, that gift that we've gotten through the appreciating market, through our initial down payment, through the amortization of principal payments over a year, 2 years, 3 years, that now we have this tremendous capital that we can access to improve our lives, accelerate our small business, or maybe a hope or a dream, or maybe invest in our child's future for education is something as well.
Yeah, and for anybody that is just wondering, what size gift that you've received over the years, you can always reach out to us. We're always here to do a complimentary personal equity assessment. We also have a tool that you can sign up for on our website called HomeBot that we do along with Steve. And it just allows you to see your home appreciate. It helps you manage your loans and see where you're at and see when it's a good time to refi or make any changes there.
I'm in the HomeBot tool. I use it.
It even shows you if you wanted to Airbnb your property, what you can expect to make, which is just
that's a pretty cool tool.
Yeah.
I've enjoyed it. My wife likes it very much because she can keep an eye on the neighborhood and what's going on in the neighborhood without having access to the MLS of what's going on in our neighborhood, and maybe make her feel better about that things are selling at a nice pace and we're continuing to appreciate in the value in the home that we love, that I've done all of these things myself. So I've accessed my home's equity to put in a pool, to do home improvements, to invest in other vehicles, second homes, investment properties. All of the things that we're talking about, I've actually used my home's equity to do that. So it's a tool that sometimes we forget about as homeowners, because a lot of times we get into a home and the goal is to pay it off as fast as we can.
Which isn't always the right answer.
It is not always the right answer. And it's not for everyone. I mean, for some people, maybe that is going to improve their lives and their quality of life, is knowing that they own their home free and clear. Mm-hmm. But for others, maybe
it's a healthy debt. You get to deduct your interest when you have a long-term liability like that you are making the payments on. It's a real good thing for your credit.
Yes,
to have that super long liability.
Yeah, history's huge as far as credit history helping your score. So again, utilizing that equity to do all of these things, and again, making personal to you, going back to everybody's situation is going to be a little bit different. Everybody's experience or needs are going to be a little bit different, and that's why having a consultation with someone like myself or a trusted advisor on your home's equity and how to best utilize it for you, at least get the facts so and then you can make a decision on what works best for you and your family.
And don't just, don't trust whatever you see on the internet. Now, HomeBot is an automation tool too, and that's why we've got a button on there that when you see it and you're questioning, is this accurate, you can reach out to us right away. We'll do a personal equity assessment.
We get those messages.
Regularly. People say, hey, can you, verify these figures? And sometimes we're saying, no, that is a little aggressive, that it would be worth that. Other times it's like, boy, yeah, that's low. It depends. Just because the entire neighborhood is appreciating at a certain rate doesn't mean a specific property is, and vice versa. Every property is unique. And so we want to look and see what comparable properties are doing. And we also know, sometimes you can't cross major streets and get a clear picture either. So we'll do those personal equity assessments for you, and get and talk with people. Just understand what your number is, and we don't want to just sit on it if we don't have to. If there's opportunities for us to make money from it or to just optimize that, then it's time to dive in.
Yeah, it's absolutely time to dive in. And something just triggered when you were talking there, that helping people to maybe just get a little relief every month going back to that debt consolidation and paying off debts to lower their overall monthly expenses is a tremendous gift that I've helped people with to save hundreds of dollars a month paying off their current debts and bills and rolling it all into that equity that they have in their home and making it work for them. It's very gratifying to be able to do that for people.
Yeah.
Gosh, I'm trying to think anything else that we hadn't covered here that you could utilize your home's equity for, the appreciation in today's market. I mean, I know it's a little bit different.
Give a gift to your friend Scott.
Well, one of the things I will talk about when it comes to refinance, because there's a couple different types of refinance that in my world can be a pricing difference. And pricing typically means the interest rate itself. So some of the topics that we discussed, so a rate and term refinance. You're not taking any cash out. You just want to lower your rate or keep your rate the same or lower your rate and get rid of the PMI, whatever that combination looks like. That's a rate and term refinance. Mm-hmm. You're affecting the rate and affecting the term.
Which you could shorten that. And, sometimes if the rate has gone down significantly, then you can take that opportunity to basically keep the payment about the same, but shorten the term
absolutely
significantly. And the rate goes down at that point too, doesn't it?
It does. It does. So when you go into a shorter term fixed loan, 15-year or 20 years, where you're going to see the biggest differences between today's 30-year fixed rates, the margins aren't as great as they used to be, but they're still fantastic. And if you can keep your payment the same and go from a 30-year to a 15-year, it's definitely something to consider. But a rate and term refinance is going to be very much like a purchase money, your best interest rate or pricing advantage when you're talking about refinances. Uh-huh. The other type of refinance is a cash out. So anything over a certain dollar level, typically on a conventional loan, it's going to be anything over $2,000 cash back to you after all fees if they're rolled or paid by the new mortgage. Paying off your current mortgage, rolling in the cost. $1 over $2,000 on a conventional Fannie Mae and Freddie Mac loan is going to be considered cash out. So again, when we're talking about debt consolidation or accessing funds for investments, down payment, all the things that we talked about, a cash out is going to be a little bit higher interest rate, typically anywhere from 3/8 to 0.5%. Again, credit score and loan to value can play into those aspects of it. But the cash out refinance is going to be a higher rate. It's not going to be that low blasted advertised interest rate that you hear on the radio or see on TV. It's going to be higher for that reason.
Now, does that look different than it did back in 2006 as well for the cash out? Or is the process similar?
Well, the process is still similar. The interest rates have always been a little bit higher on a cash out. The difference between what we were doing then to what we're doing now is you're going to be limited in the amount of equity that you can access on a cash out refinance.
Because people were just taking out way too much.
Sure, absolutely. And the program's allowed for it. And that was the unfortunate thing of what, we can have another podcast on that, what happened at that time.
Because, people were able to put in a pool, but they lost the house.
But they lost the house, right. So today it's limited. You're going to be limited because they want to limit that risk. They want you to have at least 20% equity in your home. So you're not going to be able to get a cash out refinance in most cases, Fannie Mae, Freddie Mac, FHA. You're not going to be able to get a cash out refinance over 80% of the value of your home.
Okay.
So the market value, the appraised value that we talk about, you're not typically going to be able to access more than 80% of that equity through standard mortgage products. There's some second liens, HELOCs, things like that we won't touch on today, but you could go over that. But standard first mortgage, you're going to be limited to 80% of the value of your home in most cases. And again, that is that regulating how much cash people can take to avoid
what we saw
before. I think it's a good thing. And with the equity that most people have, they realize that they don't even have to access that full 80% of the current value of their home. Most refinances I'm doing are typically in the give or take 5%, around 70% of the value of the property. So not even up to that. And I can also have that conversation with people like, are you taking too much?
Yeah.
But again, it looks a lot different in that aspect, that it's going to be regulated to the amount that you can take. And it's, again, a percentage of your value.
Well, thanks a lot, Steve. Interesting topic. And I think a lot of people, they see the numbers, they don't know what that means, don't know what they can do with it. And